In a very basic sense, for those new to market profiles, a market profile is just a trading tool. Okay, it takes data in terms of price and time. Okay, so on the top here we have prices all the way down the page, and every one of these letters represents time. Okay, typically one letter will be 30 minutes. Okay, so that's in a basic sense what this is. It's just data being put into an image, and that's all that the market profile is. It's showing us, in essence, utilizing time and price. It's showing us the auction process. So it's showing the prices over which the market auctioned over the course of every single day. Okay, that's in a basic sense what market profiling is. Now, like I said, each letter is used to typically represent 30 minutes. But note, and this is very important, market profiling has been around since the 80s, and most people don't know this. They think it's a relatively new tool. It's not. Okay, market profiling was used quite extensively in the pits in the 80s, and it was typically only time and price. Why? Well, because if you think back to the 80s when people traded in the pit, there was literally 4 or 5 hours of trading a day. Okay, there was no overnight markets and extended hours and 23 hours a day trading. So the original market profiling tool as it was never factored in volume. Okay, nowadays you'll hear a lot of professional traders talk about volume profiling. The only difference, in essence, as you can see in this image, is on the left side I've got a market profile, which is time and price, and on the right side I'm including volume and price. Okay, so I've got, in essence, on the left, market profile, and on the right I've got a volume profile. Okay, now which is better, which is worse? It depends on how you use it. It's not about one being good or bad. From a principles perspective, all of the principles applied to volume profiling also apply to market profiling. However, and this is key, a pro tip, okay, if you only observe cash profiles, so if you're a trader and you only look at the cash session, so let's say you're trading, I don't know, Apple stock, okay, it only trades in cash hours, so you can then use market profile, okay, and it's quite effective. Whereas if you're trading something that trades 23 hours a day, in essence, you want to prefer, or there is a preference to look at volume profiling over market profiling. Why? Well, because what happens in the 9 hours in the overnight session when no one's trading except for algorithms doesn't really mean anything to me. Okay, so a whole bunch of letters that are being created at a random time doesn't really give me a great deal of understanding about the auction process. Okay, so important you understand that it's not about right and wrong. What's important is choose one, choose both, apply it consistently. That's the real key, not just to market profiling, but footprint charts, to every kind of analysis you do. Be consistent with it. Don't constantly chop and change. Okay, now, like I said, both techniques are valid for me personally. What I'm going to show you today is I'm going to show you the principles using both the combined market and volume profiling and how it gets used with regards to double distribution. Okay, now, in a nutshell, there's 5 proponents that we observe from profiling. And I appreciate if you're not new to profiling, some of this might come as a little, I hadn't realized that. So, bear with me for a minute as we get through this, okay? In essence, like I said, the first thing to note from profiling is, in essence, it's an auction process, okay? It's showing me, for one, what degree of prices we traded over the course of the day, okay? Did we trade over a lot of prices? Did we trade over only a few prices? Okay, so it's showing me how the market was auctioning. It's also showing me where the market spent most of its time, okay, or where the market traded most of its volume. Okay, so it's showing me the degree of the auction process over a number of prices. Okay, now the next important part, like I said, is obviously it factors in time and price with market profiling, and on the right side, volume and price. Okay, we then have something called a volume point of control or a point of control. So this little triangle here, that's a point of control, and it's nothing more than the price at which the market spent the most time over the course of the day. Okay, and in terms of volume point of control, that's where the market, or that's the price at which most of the volume was transacted over the course of a day. Okay, now again, it's not about which one is necessarily right or which one is wrong. It's about ultimately using one of them, interpreting one of them, and then applying the principles for that going forward. Okay, the next thing we have are value areas. So you'll see orange color and you'll see black color. Okay, a value area is just in essence where 70% of the volume is distributed. Okay, so in essence, you can see that 70% of the trade occurred where these orange lines are, or where the letters are colored purple. Okay, in the black areas, that's obviously outside of that distribution. And again, all that's trying to reference to us is is there sort of volatility within the prices that the market was accepting or not? Okay, so we have things called narrow value areas and wide value areas, and that just shows us the degree over which the market was accepting price. Okay, and then finally we have key reversals. Very, very important. Things like single prints, things like tails. That's in essence this when there's speed. In other words, the market auctions very quickly away from certain price points. Okay, in this example, we don't really have a key auction reversal. We've got a little bit of an auction reversal at the low, not a perfect one by any means, but in essence, we can see the market transacted very little volume at the low, and it spent very little time. Okay, so that is an example of a reversal. It's not a key auction reversal. Okay, so those are the baseline principles. I'm not going to spend too much time on it there. It's quite an in-depth study, but in a broad sense, what you get is an understanding of the market auctions over a certain degree of prices, and using those 5 different elements, we can start to understand how it auctioned. Okay, and that's the purpose of market profiling, is to understand how participants are auctioning at different prices. Okay, now, for today's discussion, okay, where I want to start is I just want to illustrate 5 different types of profiles, because in essence, the profile type you've got will ultimately be giving you an understanding as to the price directional bias. Okay, now, there's 5 types of profiles. One we get is a normal distribution. Now, in a minute, I'm actually going to come to the blackboard and draw them for you. So just wait for a moment, okay? So we have normal distributions. They're the ones that occur most commonly, okay? And I'm going to show you that in a moment. We then have P distributions and B distributions, okay? We then have double distributions, which is the strategy I'm going to teach you today. And finally, we have trending days. Okay, now very, very important in terms of how often or how frequently certain profile types occur. As a rough idea, a market will trend 5% of the time. Okay, now if you're new to trading, okay, what typically gets sold as so the way to trade is take big RRs and 5-to-1s and 10-to-1s and all these wonderful things. The reality is markets don't auction that often. Okay, statistically speaking, 1 in 20 days the market will actually trend. Right, so if you're looking for big RRs all the time, the reality is they don't happen that often. Right? And that's why at Tradelo, we focus more on high probability plays where we can get good risk reward, where we can try and find asymmetry in terms of risk reward, but we accept that good trades sometimes have got 1.5 to 1 risk reward. Okay, we're not looking for home runs all the time. We're looking for home runs when the market actually offers them. Okay, so trend days don't occur that often in terms of double distributions. Okay, again, they're not frequently occurring. They do happen a little bit more often than trend days, but typically speaking, double distribution days will occur around 15% of the time. Now, the reason I show you that statistic is because if you think that 15% of the time, that's roughly 3 days a month in your market, you're going to see this strategy. Okay, so you have to factor that in, because it's not a strategy that occurs all the time. It's not a strategy that, ultimately you're going to see it every single day. It's a strategy that will occur roughly 3 times a month. Okay, now, if you go and apply it across different markets, you can make a very good living just trading double distributions. Okay, and then obviously the other 3 distribution types, BP and normal distributions, they will typically occur around 80% of the time. Okay, in other words, let's have a look. If we think of a normal distribution, okay, a normal distribution is just simply the market auctions, okay, over a series of prices, but there's very little effort and time spent at the lower bound and very little effort and time, I'm just going to color this differently, spent at the upper bound. Okay, so the way you can think about this, I don't want to use the word support and resistance, but how you can think about it is the market comes down, it finds liquidity, no one wants to sell it anymore, and everyone wants to buy it, and price goes up. And then it runs into someone providing sell-side liquidity, and no one wants to buy it anymore, and everyone wants to start selling it. Okay, and that's how a normal distribution is formed. Effectively, the market just spends time between 2 pockets of liquidity. Okay, there's very little interest to auction below that point and very little interest to auction above that point. And we call this a balanced market. In other words, buyers and sellers, by and large, are in agreement that we're just going to spend the day trading between these 2 points. Okay, now if you go look at the S&P 500 today, that's what you're getting. You're getting a balanced day type. Okay, the S&P, someone's happy to sell it up at what, 26s, and if you have a look later on today, you'll find someone's happy to buy it a little bit lower down, and they just want to distribute between 2 points. So we're distributing in a normal distribution type where there's a lack of initiative below the low of the day and a lack of initiative above the high of the day. Okay, and that's a very typical pattern play. You will see this occurring most of the time. At least 50% of the time, you will see normal distribution days. Now, a variation on this, in other words, a slight tweak on this, is where we get something called a P distribution or a B distribution. Okay, and this is a little bit of a variation where, in essence, what we see is a little bit of auctioning. Okay, so we can see the market spends very little time. Okay, now when I'm illustrating these sort of shapes, that is the shape of the profile. So we can see the market spend very little time and very little volume transact around the low. And in essence, the market then auctions, finds some sort of pocket of liquidity, and then again, it does the same thing. So it's a normal distribution, but with a long tail in essence, where the market thought, hey, this price point is a little bit of a discount. We're going to buy it up quite quickly and go and trade prices at a higher area. Okay, the B is just the opposite to that. In essence, again, we have a little bit of a sell tail, and the market then accepts value a little bit lower down, spends very little time at the upper bounds of the day session. Okay, now combine these three, like I said, those three pattern plays or profile plays, you'll see roughly 80% of the time. Okay, the next two then is we then have the double distribution day, okay, which I'm going to talk about predominantly today. And then finally, we have the trend day. Now, before I get to a trend day, let's talk a little bit about what's going on in a double distribution from an auctioning process. Okay, typically speaking, the market will spend a lot of time, or it will transact a lot of volume in one or two of these regions. Okay, and over the course of the day, at some point, for a reason, the market will trigger an auction process. In other words, we'll be trading all year, everyone's happy, and all of a sudden, the buyers initiate, the buyers engage, the buyers say, we are now going to lift available offers, and we're going to auction this market to higher prices until we find liquidity. Okay, and what typically happens then is the market goes in search of that liquidity, goes in search of price discovery, eventually it runs into it, and then we start to distribute again. Okay, no one wants to buy it up there, everyone wants to sell it, it pulls back, everyone wants to buy it, no one wants to sell it, and we begin the process of forming two unique distributions. Okay, we'll talk a little bit about this in great detail on the next slides, but for now, that is a double distribution. And then finally, what we have is a trending day. Okay, now trending day looks a little bit like this in terms of distributions. Okay, we have a little bit of volume being accepted, and it moves and auctions and forms a tiny distribution. Okay, it's effectively where we have a day where we have multiple little pockets of value being accepted, but no real sort of long amounts of time or great degree of volume ever gets traded at any sort of series of prices. Okay, so it's a day where the VPOC perhaps stops here or starts here, it gets shifted up here, it gets shifted up here, it gets shifted up here, simply because as the market is auctioning higher, it's running into some liquidity. People want to happily sell it, but then they stop selling it and the buyers engage again, and they go and search their liquidity. They find the liquidity, someone sells it, it starts to form a bit of two-way trade. Again, the selling finishes, the buyers still want more, and they go again, and they go again, and eventually the market exhausts itself. Eventually, the buyers are no longer willing to buy. The sellers don't want to sell because they've all been trounced and there's no point in being short, and the market just settles in the higher end of the range. Okay, this is a typical trend day where the market just cannot find sufficient liquidity to rotate in any meaningful way. Okay, those are your 5 profile types. Now, what you'll notice, and this is important, like I said in the beginning, 80% of the time, all right, markets tend to be either in a normal distribution or a P and a B. And what that means, and this is important to stress, that means 80% of the time, there isn't much price directional bias in the market. Okay, and most traders don't get that. Most traders come in and they go, well, today I'm going to buy it because it's going to go up. In essence, 80% of the time, the market is in essence distributing between 2 price points. Okay, so factor that in, because too many traders are looking for home runs every day. What you should be looking for is where can I apply myself, take those 20, 30 ticks, because I know 80% of the time the market is going to be distributing. More importantly, know when the market is potentially going to shift into double distribution days or trend days, and make sure you can capture and take advantage of that. Okay, that is ultimately what market profiling is all about. It's about, in this context, let me look to take what the market's offering, which is a distribution opportunity. However, in these instances, I need to shift. I need to shift a gear. I need to be willing to expose myself to that bigger trend day that comes 5% a day. Okay, and that's the art form around market profiling.